Good morning, everyone, and welcome to Julius Baer's Moving Markets podcast. It's Friday, the 10th of April, and my name is Helen. My first guest this morning will be Roman Canziani, and he'll be giving us a roundup of the latest news in financial markets. And I'm also joined by Thomas Caflisch this morning, who'll be filling us in on the latest moves in FX and metals markets. But first up with the market news is Roman. Good morning, Roman. Thanks for joining me.
Good morning, Helen.
We've had a dynamic week, haven't we? A lot of moves in both geopolitical landscapes and financial markets. We saw a substantial bounce across markets midweek, fueled by hopes of a ceasefire in the US-Iran situation. Yesterday brought a more mixed picture, but ultimately ended positively in the US. Can you give us a few of the details, please, Roman, on what's been happening across equities?
Absolutely. Well, European markets gave back some of those substantial gains from yesterday, finishing slightly lower. US markets managed to claw their way higher after news emerged of Israel agreeing to direct negotiations with Lebanon regarding a ceasefire, with all major indices in the US ending the day in the plus. That overnight positivity has carried through to Asia this morning, with markets broadly higher, with the Nikkei up almost 2%. And also Chinese shares are rallying after factory gate prices there rose for the first time in more than 3 years. With regard to yesterday's market action in Europe, there was actually one really noticeable economic news, and that was that Germany's industrial sector was already struggling before the war. February numbers saw a 0.3% dip in industrial production, continuing a trend of weak activity. While new orders saw a slight increase in February, this was driven by a few large contracts and doesn't indicate a widespread recovery. Excluding those large orders actually decreased, so there had already been economic headwinds before the war kicked in.
And speaking of headwinds, the EU Commissioner Valdis Dombrovskis recently flagged the risk of a stagflationary shock. That sounds unpleasant. Could you unpack this a little bit for us, please?
Unfortunately, it is. Stagflation is a really difficult scenario, a combination of slow economic growth and rising inflation. The EU is particularly vulnerable because of its reliance on energy imports. Even with the improving diplomatic outlook, the potential for disruptions to oil flows via the Strait of Hormuz remains a serious concern. According to the Commissioner, EU growth forecasts could be lowered by up to 0.6% if high energy prices persist. Simultaneously, inflation could climb by 1 to 1.5 percentage points. It's a double whammy. Several EU countries are cutting fuel taxes to mitigate the impact, but the Commissioner rightly cautions against turning this into a full-blown fiscal crisis.
And looking at individual companies now, SAP took a pretty hefty tumble this week. What's going on there?
Yes, SAP shares fell almost 7% yesterday after their CEO warned of short-term pain during their transition to artificial intelligence. It's a classic story of investing for the future, but with immediate consequences. The CEO likened it to their previous cloud transition, acknowledging that it will initially hurt margins. However, the challenge with AI is that it's largely uncharted territory, making the outcome much harder to predict.
And this ties neatly into the broader struggles within the US software sector. We're seeing significant declines there, aren't we?
Exactly. The S&P 500 Software and Services Index is down over 25% this year. Yesterday, it fell more than 2%. Anthropic's new Claude Mythos model, though limited in access due to security concerns, has amplified fears of AI-driven disruption. It's exposing vulnerabilities in existing software and adding to anxieties surrounding private credit markets. Cybersecurity firms, alongside larger players like Salesforce and Adobe, have all felt the pressure, ending the trading day sharply down in the US.
All right. And turning to the US economy now, we're getting crucial CPI data today. What are the expectations and how might these numbers influence the Fed's thinking?
Expectations are for a 0.9% monthly increase in headline CPI and a 3.3% year-over-year rise. Core CPI is projected to increase 0.3% monthly and 2.7% annually. These numbers are certainly elevated. Recent consumer spending data shows only marginal growth in February, partly due to persistent inflation and rising energy costs. Real disposable income actually fell. While the labor market appears somewhat stabilized, the overall picture suggests inflationary pressures are building. The Iran conflict exacerbates this, driving up fuel and material costs. All eyes will be on the CPI report today, as it will heavily influence the debate around whether the Federal Reserve will proceed with its anticipated rate hikes. Currently, traders still expect 2 rate increases this year, but that could change depending on the data.
Okay, and finally then, let's quickly touch on commodities and currencies. Anything noteworthy to mention there, Roman?
Well, stating the obvious, oil prices experienced volatility this week, initially spiking on escalating tensions before retracing ground as the escalation hopes grew. Brent is currently trading up around 2% since yesterday, above $96 a barrel. Still, as I said before, Asian markets are reacting positively to the prospect of continued dialogue, with Japan planning to release oil reserves too. On the currency side, the US dollar is bound to deliver its first negative weekly performance since the war kicked in. Overall, the market is walking a tightrope, balancing hopes for peace with the ever-present threat of renewed escalation. That's it from me.
All right. Thank you very much, Roman, for the great roundup this morning.
Thank you very much, Helen. It's always a pleasure.
And now over to you, Thomas. Good morning, firstly.
Good morning, Helen.
So it's been a few weeks, Thomas, since we had you on the podcast to talk about currencies. What can you tell us about what's been happening since your last update?
Yeah, that's right. Not too much happened at first glance. The dollar in general trades marginally lower since we talked last time 3 weeks ago. Back then, I assumed the dollar would remain bid as long as the conflict in the Middle East goes on and oil prices remain elevated. And the dollar was indeed trading higher, at least until Tuesday, when a surprising truce was negotiated. The dollar immediately lost about 1% and is consolidating since.
Okay, and your thoughts on what to expect going forward?
Well, I think we have 2 scenarios. One is that the ceasefire holds, a peace deal is agreed, and ship traffic resumes through the Strait of Hormuz. Difficult to believe, but hopefully not impossible. In such a scenario, we would see a lower dollar, basically back to the world before the conflict, where US policy uncertainty has been a key driver in the dollar's depreciation. Inflation fears would rather be in the background again, and growth concerns would get more weight. A consequence would be renewed expectations of rate cuts in the US. In this context, we must not forget that the new Fed chair, Kevin Warsh, will take over mid-May, and markets speculate that Warsh only got the job because he promised Donald Trump to cut interest rates. The second, but probably more likely scenario is that the conflict continues and oil prices remain high. That would again support the dollar and put the new Fed chair in a difficult situation. He would have problems to justify rate cuts in such a scenario.
Okay, so on rate cuts, what are the expectations in terms of interest rates now after they've changed dramatically when we spoke last time?
Currently, the market is pricing only 6 basis points in rate cuts for the US until the end of the year. This comes after the panic reaction 3 weeks ago, when the market shifted from an expectation of 50 basis points cut to 25 basis points hike within days. In the Eurozone, the market is pricing in 2 rate hikes by the ECB until year-end. The higher oil and gas prices have a stronger impact on inflation in Europe than in the US. And even in Switzerland, futures imply a 20 basis point hike by the SNB until year-end.
Now, just finally on metals, they recovered from the dive they took at the beginning of the Iran conflict. And now are they continuing to go up?
Yeah, I think so. Unless we see another aggressive sell-off in equities and bonds, I think the worst is over for precious metals. After some consolidation, Especially gold should meet good demand and trade higher again.
All right, very good. Thank you, Thomas, for joining us this morning.
Thank you, Helen.
So that is all for today. Thank you again to my guests, and thank you all for tuning in. Please subscribe to our show if you enjoy it, and you can, of course, also leave us a review on whichever platform you like to listen on. So we'll be back again on Monday morning. Do join us then when Bernadette will be back as your host, joined as always by more of our colleagues to talk about what is moving markets. But until then, I wish you all a great day and then a great weekend. Bye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.